Welcome to a new episode of Inside the Economist's Mind. Today on the deep dive, we're tackling something that's really central to how our financial world operates, understanding banks' funding costs and their lending rates.
Yeah, knowing how these work is, well, it's key, especially when we look at how central bank decisions, filter through the economy and ultimately affect things we all care about, like inflation and economic growth. The rates banks pay and charge are just fundamental.
Exactly. So your mission today, listener, if you're up for it, is to get a really clear handle on what these costs and rates are all about, what makes them go up or down, and basically get yourself up to speed on this cornerstone of economics.
We'll be looking at some material breaking down these concepts. Okay, so let's unpack this. Right at the foundation, what exactly are we talking about with bank funding costs and lending rates?
Well, put simply, banks are kind of like intermediaries, right,
Hmm.
between savers and borrowers. So think of households and businesses putting money in the bank. Those are the savers. The interest the bank pays them, that's a big part of the bank's funding costs. Okay, the cost of getting the money in the first place.
Exactly. And then on the flip side, the interest that people and companies pay back to the bank on the loans, that's how the bank makes income. Those are the lending rates.
Got it. So savings flow in, bank pays interest out, that's the cost. Loans go out, bank receives interest back. That's the lending rate driving revenue. We've even got a simple visual here. We looked at bank in the middle, arrows showing savings in from savers, interest paid back to them, then loan out to borrowers, and interest paid coming back to the bank. Really clarifies the flow. So where do banks actually, get all this money they lend out?
Here in Australia, it's mainly two big sources. The largest chunk, maybe around two-thirds, comes from deposits. That's money held by everyday Australians and businesses. Your transaction accounts, savings accounts, term deposits, that whole pool.
Okay, so mostly our collective savings. Makes sense. What about the other third or so?
That mostly comes from banks borrowing money themselves. They issue bonds, other kinds of debt securities in the financial markets, so they're borrowing from investors, basically.
Ah, right. Borrowing to lend.
Yeah. And then the small bit left over is equity capital from things like selling shares in the bank. And if you want the absolute latest numbers on this, the Reserve Bank actually publishes this monthly in their chart pack.
Good tip for anyone wanting the fresh data.
Mhm.
Okay, let's zero in on those funding costs. What really drives how much it costs a bank to get its hands on these funds? We know the cash rate from the RBA is important, but
It is. It's definitely a key influence, a benchmark. But, and this is crucial, the rates banks pay on all their different funding sources don't move, perfectly in sync with the cash rate, not by the same amount or at the exact same time.
right, so it's not just a simple follow the leader situation. What else is going on? I see market reference rates mentioned here. What are those?
Okay, so market reference rates are essentially interest rates based on lots of actual frequent trading in financial markets. Because they're based on real transactions happening all the time, they become really reliable benchmarks for the cost of money in the wholesale market. Banks use these rates to help price the bonds and debt they issue. A key one in Australia is the bank bill swap rate, BBSW.
BBSW.
Okay.
Think of it as like the wholesale price for short-term money between the banks themselves. And because they trade so much, it's a very solid indicator. What's really interesting is how fast changes in the official cash rate flow through to these market rates, almost immediately, actually. Our timeline graphic shows that pretty clearly.
Okay, so cash rate changes hit the wholesale funding market almost instantly. That makes sense. But what about the rates they offer us, the depositors? That seems slower. Exactly. Deposit rates are less directly tied to the cash rate, and the transmission is definitely slower. Partly because banks have more discretion here. They can decide what rate to offer. And they think about other things too, like how much they actually need deposits compared to borrowing elsewhere.
So competition plays a role.
Definitely. If a bank really wants to attract more deposits, maybe because they see them as very stable funding, they might bump up their deposit rates to compete, even if the cash rate hasn't budged. Our graphic shows this lag deposit rates tend to adjust over the next month or so after a cash rate change. So the central bank moves the main lever, but banks have their own dials, like competition, affecting the pass-through to savers.
Interesting. So competition can actually work in savers' favor sometimes. Now, the material also mentions other monetary policy tools beyond just the cash rate affecting funding costs. This sounds like the less conventional stuff.
It is. Things like extended liquidity operations, often called term funding schemes, can have a direct impact. These basically let banks borrow from the central bank, usually at a very low rate, for a set, often longer period. The idea is to push down and stabilize bank funding costs, especially when, the economy's struggling and the cash rate is already near zero. It's like a backstop providing cheap, reliable funds.
Right, like the term funding facility during COVID. We should definitely talk more about that specific example later. What other tools?
Well, policies that influence the whole risk-free yield curve, think asset purchases or quantitative easing and forward guidance, they can also play a part. These policies affect those market reference rates we talked about, like BBSW, and that in turn affects what it costs banks to issue their own debt.
So it's indirect but still significant. Lowering the benchmark borrowing cost across the market helps banks too.
Exactly, it's all connected. And beyond monetary policy, are there just sort of basic supply and demand things happening?
Oh, absolutely. Basic economics always applies. If lots of banks are suddenly competing hard for deposits, maybe everyone wants term deposits, then the price they pay the deposit rate will likely edge up.
And similarly, what investors demand as compensation for buying bank debt can change too, depending on how risky they think things are or what other investments look like.
Okay, that paints a good picture of the funding cost side. Now let's flip it. What influences the rates banks charge us when we borrow the lending rates?
Well, banks are fundamentally trying to lend profitably, but they also have to manage the risk, that borrowers might not pay them back. So, lending profitability is basically the gap between what they expect to earn from the loan and what it costs them to fund that loan in the first place.
Funding costs seem like the obvious starting point then. If the bank's costs go up, they'll probably need to charge borrowers more to keep their margins, right?
Generally, yes, that's the direct link. Higher funding costs often lead to pressure to increase lending rates to maintain profitability, but it's a balancing act. If they push rates up too much, fewer people might want to borrow, right? And that could actually hit their overall profits. So they have to think about demand too.
Right, they can't just pass it all on without consequence. What about competition on the lending side? We talked about competition for deposits.
Yeah, same logic applies. If there's heaps of competition among banks trying to lend money, maybe loan demand is a bit soft, they'll likely have to compete on price. That means potentially lower lending rates to win customers and keep their loan books growing. More of a borrower's market, you could say.
Makes sense. And the last big factor mentioned here is credit risk. The chance borrowers won't repay. How big a factor is that?
Oh, it's critical. Banks assess the risk for, well, pretty much every loan. How likely is this borrower or this type of borrower to pay it all back on time? That risk assessment feeds directly into the interest rate. Riskier loans, like, say, unsecured credit card debt compared to a mortgage backed by a house, will almost always have higher rates to compensate the bank for taking on more risk.
And that risk perception can change.
Definitely. The bank's overall view of risk in the economy can shift. If they think a recession is looming, they might see more risk everywhere, become more cautious, and that could mean higher rates or just being tougher on who they lend to.
So it's not just your situation, but the whole economic outlook influencing your loan rate. Okay, let's quickly unpack that box on the term funding facility. That was a major move by the RBA, wasn't it?
It really was a key part of the COVID-19 response announced back in March 2020. Essentially, the TFF gave banks access to a huge pool of funding, about $200 billion worth, at a very, very low fixed interest rate for 3 years. And crucially, that rate was much lower than their other funding options at the time.
So the RBA was directly injecting cheap money into the banks. What was the goal?
The main goals were, one, lower the bank's overall funding costs, and two, hopefully see them pass that saving on through lower lending rates for businesses and households, keep credit flowing. But there was also a clever twist. It's specifically incentivized lending to businesses, especially small and medium ones.
How'd that work?
Well, the more a bank increased its lending to small and medium businesses, the more funding it could draw down from the TFF. It was like a bonus. For every extra dollar lent to an SME, they could get $5 extra from the TFF. For large businesses, it was 1-for-1. So a really strong nudge to lend to those smaller firms.
That's quite targeted. So lower costs overall, but also a specific push towards business lending, particularly SMEs.
Exactly. It was designed to support credit flow where it was arguably needed most during that really uncertain period.
Well, this has been incredibly useful, really breaking down how these rates work. Just to quickly recap the key things. Banks are intermediaries. Funding costs are what they pay savers and lenders. Lending rates are what they charge borrowers.
Yep. And the cash rate is a big influence, but market rates like BBSW react faster, while deposit rates lag and depend partly on competition.
And we saw unconventional tools like the TFF can lower costs directly, while things like QE work more indirectly through market rates. Plus, basic supply and demand matters.
Right. And for lending rates, it's a mix of the bank's own funding costs, how much competition there is for borrowers, and, really importantly, their assessment of credit risk.
And it's all connected, isn't it?
Mhm.
Changes ripple through the system, affecting borrowing costs, the economy, inflation.
Absolutely. It underpins so much of how monetary policy actually transmits to you and me.
So hopefully for you, our listener, that gives a much clearer picture of these fundamental mechanics, how banks work, how policy filters through, and maybe here's a final thought to chew on. How might big global shifts, changes in overseas interest rates, major geopolitical stuff, how might those things start to impact all these factors influencing bank costs and lending rates here in Australia, maybe in ways we haven't even fully seen yet? Something to keep an eye on.